Okay, so let's do this problem. Do this problem. Okay, so what you need to do is find the expected future growth. So what is the expected future growth? What you have been given. So what do you need to remember here? What is the formula for the growth rate? So the growth rate is the retention ratio multiplied by return on equity. And what is the logic for this? So what's your name? Zarak. So what's the logic for this formula? I'm asking for the logic behind this formula that we discussed last time. Okay, pass. Next. Okay, next. See, we discussed certain things, but I'm asking you for. Okay, next. You're still absent. Okay, next. Your name? So what's the logic behind this formula? Okay, next. Actually, I've been through this, but I haven't been through the entire. Okay, next to Azza is your name? Anush. Okay, good. You know that. Okay, next Azza. Yeah. So how hard is that? Companies that retain more money are more likely to grow faster, or companies that retain less earnings are more likely to grow faster? Okay, is that rocket science or is that fairly obvious? Fairly obvious. Okay, Serish, so while we are on this obvious roll, what about return on equity? What is return of equity? Return on equity. What's the, okay, what is, okay, Azza. Okay, thank you, Azza. Okay, so it is the net income divided by equity. So now, your name, have I been through the whole class now? Okay, you can see where you stand. All right, so return on equity is net income over equity. So it's effectively how much money or income you are generating on your investment. Companies that generate a high ROE, that means they are doing very well against their investment, are more likely to grow faster. Companies that do not get a good return on their investment or on their equity are less likely to grow. Okay, so that's the formula. You just multiply it out and you get a growth rate. Okay. Now, if you have this formula, so you are given the current dividend, you are given the price, you are given a growth rate. What is the cost of common equity based on the discounted cash flow approach? Okay, one second, I didn't ask you to shout it out. So you just write it. I want to see who can do this. So we studied this last time. We just talked about it. So I want to see where and what extent is registered. Okay, what's the formula that we spent about 20 minutes already to come up with? Okay. So the required return based on this discounted cash flow model, this is also, I'm going to find out later how many people understand why this is called discounted cash flow, but we'll come back to that. The cost of equity is, what's the formula? D1 over P naught plus G. Now, almost 80% of the people I saw, there are three parts to any formula, or three, this is taking a step back and giving you some, higher level wisdom. So with the formula, one is memorize the formula. Okay, that's part number one. Part number two is it's very useful if you understand the intuition behind the formula. For many formulas, there is an intuition. For some, it's just very hard. So I will tell you where the intuition is good, where you don't need it. But in general, it's good to have the intuition. And the third is you need to know how to use the formula. Okay, 1 and 3 are essential. 2 is good to have. Okay, so now if you are writing down D1 over P naught and you are told that D naught is 4.19 and you are still plugging in so you are plugging in the D naught number for D1, what does that say about the intelligence level being used? Okay, so you need to boost, so expand your brain. Okay, so you are given D naught Are you given the growth rate? What G is this? This is growth of what? Yeah. Not told explicitly, but that's a reasonable assumption to make over here. Okay, so if you are told that the current dividend is D0, you are told that the dividend is growing at 5%, so does it take a genius to figure out what D1 should be? So Serish, what's D1? Exactly. So it will be simply 4.19 into 1.05. So what you should have done is D1 is that number 4.19 multiplied by 1.05 divided by 50 plus the 0.05. Okay, so that's you can I'm sure everybody can do the rest. Okay, so that's your answer. You should get about 13.8%. Okay, now just another check. How many people know why this is called the DCF approach? Yeah, Turab.
Because we are discounting back the future cash flows.
Exactly. This is called discounted. What are the future cash flows that we are discounting? Dividends. We are essentially modeling the dividends as what? Okay, so that's a start. So you are beginning to show up. Okay, next, Sophia. How would Hassan, right? Hassan. Okay. So Hassan said we are modeling the dividends as a perpetuity. One second. So Sophia. So is he right? Oh, okay. If he were right, I probably wouldn't quite come to you, but still. He's not right. Okay, that is better. But so can you say what is right? All right. So somebody else? The question is, we've established that we are using the discounted cash flow model because we are discounting future cash flows. The question is, we are modeling future cash flows as what? As a perpetuity, as an annuity, as something, as a growing perpetuity. You just said perpetuity. There's a big difference. What's the difference between a perpetuity and a growing perpetuity? Yeah. So a growing perpetuity keeps going at a constant rate. A perpetuity is the same cash flow forever. Okay, so and finance, or it's actually simple mathematics. The present value of a perpetuity, if I told you that you will get a dividend of 4.19 forever, okay, that would be a perpetuity. Then what would the cost of equity be? Divide what by what? Exactly. So if I told you that this was 4.19 forever, then that would be called a perpetuity, and then the cost of equity would have been D1 or D0. Would there be any difference between D1 and D0? It would be the same. So it would simply be 4.19 divided by 50. But in this case, it's a growing perpetuity, so you take D1, and the formula where exactly that came from, that is just some smart genius did it. You just need to memorize that formula. Okay, so that's this question. Okay, so somebody, can you answer this question?
Yes, sir.
You started out right, but I don't know if you are explaining. Okay, let somebody else. So, who is feeling? Yeah, what's your again? I keep forget your name. Anusha. So, if I catch you talking, then you'll be on the spot. Okay. So no, you Azza. Okay. Okay. I'll just spare Serish. All right. So at the back, Uruj. Okay, but what do you think we'll do here if we don't have constant growth? Exactly. So actually your intuition did not serve you too well, so you need to study harder. The harder you study, the smarter you get, the better the intuition gets. All right. So intuition without enough knowledge can be dangerous. Okay. So the point here is, if the dividend is not going at a constant rate, if I just tell you all these future dividends at period 1, 2, 3, so you can this is a brute force method. Why do I call this brute force? Because you have to then estimate every single dividend and discount it back. Okay, so we can, yes, non-constant growths are expected. So very often what happens is that for the next few years, you might have non-constant growth. You might have a stock that's growing at 20%, 30%, and then you make an assumption that at some point in the future, the growth stabilizes. No, yeah, it is brute force. It's a lot of work. Okay, so you have to model every dividend, and let's say for every dividend, let's say here it's 10, here it's 20, here it's 25. Is this the constant growth rate? 27, 29. So you then discount every single cash flow. And then just as a quick side point, you might assume that the overall present value of the dividend is worth something in the future. So that's called a terminal value, and you discount that back too. So you will see more of this later. Right now, just take it as a given that there are ways to solve more complex problems. You just need to make some assumptions. Exactly, at some point in the future. You've seen that before? Have you done this in IBF? Okay. So let's just go through this. Okay, I'll come to yeah. We can't use, the G can only be used if that G is constant growth moving forward. Okay, so if we do, so I'll leave it at this. I'll just plant it in your head that there are ways of dealing with this that you might see in more advanced classes, or if you do the CFA, then there are more details on this. Otherwise, just general intuition that it's doable. Okay, now we come to the third method, which is the required return is the bond yield. Let's say bond yield is 12% plus a risk premium that some of you remembered from before. So what is this risk premium? This risk premium, is this the market risk premium? It is a risk premium specific to this stock. So it is saying that what is the additional risk of owning this particular stock over the rate that I would get by holding the bond from this particular company. Okay, so that is saying that if a company like Engro issues a bond, do you know if Engro has ever issued a bond? Yeah, a year or so ago it issued the Engro Rupaya. Okay, so let's say that the bond yield, does anybody know the yield on that? So it was about 14.5% or something like that, right? So now, one way of coming up with the required return on Engro stock, do you think the return on Engro stock, so if you go invest, buy 1,000 shares of Engro, should your return be 14.5 more than that or less than that? What would you be expecting or hoping for? Yeah, because it's more risky to buy the stock. So to take more risk, you would require an extra compensation. So just think of it this way, that let's say that based on the riskiness, additional riskiness of that stock, you require an extra compensation of say 4%. That 4% is specific to Engro. It's not a market risk premium. It is a risk premium specifically for that stock. So this is another method where you figure out, okay, for my company, the additional risk premium over the bond would be about 4%. Okay. Okay, so right now you don't need, it's a guesstimate. Partly you guess, partly you estimate, you look at the market, you look at your credit rating, and fortunately for you, we don't need to get into details of that. All you need right now is the intuition that it will be a number added to the bond yield, and the more risky your common stock, the more that number. For example, I'll just give you some more intuition. Two companies, one company has taken on a lot of debt and is operating in a market where sales are very volatile, versus another company that doesn't have as much debt and is operating in a very stable environment. Okay, which company will have a higher risk premium? The volatile sales. So So at this stage, having the intuition that the more risky the company is, either based on its capital structure, how much debt it has, or based on the business it is in, so the more risky, the higher the premium. Okay, so now whether it should be 4.5 or 4.9 or 7.8, that is outside the scope of what we need to do. Okay. Okay, now, okay, so prove that you are a genius and do this. Okay, good. It is 14%. Okay, that's not a trick question, so there is not much to it. It's unlikely that, well, you might get this question, and if you get it wrong, then you'll just be failed without looking at anything else. Okay. Now, the big picture is that what we've done is we have taken 3 different methods for calculating the cost of equity and got different answers. Is it a surprise that we have different answers? No, because all these models are just approximations. Okay, so if you don't have, as in if you are not overly confident about any one particular model, then what do you do? Yeah, just take an average. So if you have no strong basis to pick any one, then you take the average. Okay, so conveniently in this academic example, our estimate turns out to be about 14%. Yeah, it's a coincidence. Unless you reverse engineered and just came up with that estimate after doing the other 2. But anyway, in this case, it is a coincidence. Okay. So do you think it's cheaper to use your retained earnings, or is it cheaper to, what does issuing new common stock mean? Yeah, floating more shares. So do you think it's cheaper to just use your retained earnings, or is it cheaper to float shares? Okay, so that's a reasonable. Actually, what we are getting at is this: when you float shares as a company, say you are Engro, okay, there is a cost associated with floating your shares or issuing debt. Why? Because will you just be able to do that for free, or do you need to pay investment bankers a ton of money? You need to spend a ton of money on advertising. So when Engro issued bonds, or when, say, Fatma Fertilizer had a IPO, you saw advertisements. You saw that probably Arif Habib or some other entity was the underwriter or the broker. So do you think those entities do this for free, or do they charge a ton of money? So they charge money, marketing costs, distribution costs, all those can add up. Collectively, those costs are referred to as flotation costs. Okay. So when you issue new shares or you issue new bonds, there are flotation costs. Okay. Now, because of those flotation costs, the overall cost of issuing something new, be it shares or be it bonds, becomes more than just using your retained earnings. Does that make sense?
Yes. Always?
Always. Okay, so because that flotation cost is always going to be there, unless you can find an investment banker that will do it for free. But if you find a banker like that, let me know. Bankers are just out there to make money. Okay, so they make a ton of money on transaction costs, and clearly that is going to add costs. Okay, anyway, so that should be obvious. Okay, this I'll get to later. Okay, issuing new common stock incurs a flotation cost of 15%. Then what is the cost of equity? So I'll just help you do this. The concept is this, just pay close attention here. So if we know that the flotation cost is 15%, right here, this is how the formula gets modified. If I were to remove the F, let me just in parallel write the formula that you are familiar with. The cost of equity is D1 over P0 plus G. Does this look familiar? Okay, now let's look at what we have over here. Instead of D1, what's been written is D0. Is this the same thing? Okay. Instead of P0, we are writing P0 into 1 minus F. Okay, now why is this? F is the flotation cost, which is 15% or 0.15. Very often, flotation cost is modeled as a percentage of your proceeds. When you issue a share, let's say one share, what are your proceeds from one share? When you issue your stock, how much money are you getting? $50 in this case. Okay, so the proceeds are $50. But if the investment banker says that from all your proceeds, you need to spend your flotation cost, which includes my fee, the distribution fee, the marketing fee, etc., is 15%. Then as a company, let's say you are the company, from $50 share price, how much do you actually get? Yeah, you get 50 minus 15%. So 50 minus 15%, how can you come up with that? It's the 50 into 1 minus 0.05. How's that expressed in the formula? P0 into 1 minus the flotation cost. Okay, so you will notice that the flotation cost does what to the denominator? It decreases the denominator. So what will it do to the overall cost of equity? It will increase the cost of equity. Okay, so this is a good candidate for what you might see on a quiz or an exam, because this is testing your knowledge of this discounted cash flow model, and it is testing whether you can apply a flotation cost. So it should not be very hard to remember, because hopefully by now you remember this model, and then all we are saying is if there is a flotation cost, you as the company will not get the full stock price, you will get a stock price minus the flotation cost. Okay, hopefully that's clear. The way you should think about this is the greater the flotation cost, the greater the cost to you as a company. Okay, so this is from the perspective of a company. What's this chapter called? Cost of capital. Remember, just as a perspective, this course generally is from the perspective of a company. So it's called financial management. It can also be called basic. In many universities, this course is called basic corporate finance. Okay, so this is from the perspective of a company. There can be another course that is called investments, which would be from the perspective of investors. Okay. The question is, is the major underwriter will only be one? Often, but not necessarily. Okay, if you say the major underwriter, then okay, there's one major underwriter, but there can be other underwriters. But that you can see in a course on investment banking. There's the detail on underwriting. Right now, you can just think of the underwriter or the investment banker as the entity that helps issue new shares. And then there are several things the underwriter can do. So that's a separate activity. The cost becomes higher. So you are a company, the more you pay your investment banker, the higher your cost. Right? So think of this as the cost. What are we talking about? The cost of equity. Okay, so if you're still unclear, then just see me after class. I need to get through this. Okay, flotation cost depends on the risk of the firm and the type of capital being raised. Flotation costs are highest for common equity. However, since most firms issue equity infrequently, the per project cost is fairly small. Okay. We will frequently ignore flotation cost when calculating WACC. So unless you are told otherwise in a problem, you can just ignore flotation costs. Obviously, if you are given the flotation cost and you are asked to factor it in, then you can't say I'm ignoring it. Okay. Okay, so next, a firm's WACC. Let's say a firm has an optimal structure of 30, 10, 60. We'll talk about this later, but what this is saying is that what a firm wants to do is, so here what we are saying is, these are the weightages to use. Weightages, let's say a company issues bonds, it has equity and it has preferred shares. So what is being told is that debt is 30%, preferred shares are 10%, and common stock is 60%. So then what we have is WACC is equal to weightage is WD into RD. So this formula now is coming back because now we have figured out all 7 items. So we are given the 3 weightages. Let's say that the tax rate is given at the tax rate is 40%. So 1 minus T is 60, and RD we calculated as 10%. What's the 9%? That was the cost of preferred shares that we calculated last time. And what's the 14%? That's the cost equity multiplied by weight. So 11.1 is the weighted average. So you can be pretty sure that in your quiz you will be expected to know this formula. This is perhaps the most important formula in this chapter. Why? Yeah, it's exactly. So it is the cost of equity, the cost of capital. So this is the formula that ties together all the components. Okay. Now how are these weightages determined? Do you understand this question? How do you figure out? So let's say you are the CFO, recently joined this company, and you are amazed to find out that the company doesn't have its cost of capital defined. All right. So you need to figure out what the cost of capital is. And the first thing you want to see is what is the relative weightage of my components. Yeah, you can also look at that, but first let's look at ourselves. Okay, so our company, how do you figure out what the weightage is? One question is, will you use accounting numbers or market value numbers? What does this mean? Yeah, so accounting numbers means that you simply look at how would you, if I say, okay, give me the weightage based on accounting numbers. So Saad, right? So how would you come up with your weightage based on accounting numbers? So I'm the CEO. I think I know what I'm talking about. I tell you, come up with the weightage based on accounting numbers. Okay, that's a smart point. Okay, you started out right. Okay, Omar. Okay, so there's good usage of jargon, but answer is not very clear. Okay, so I'm looking for a very simple state. How do you use accounting numbers to figure out weightage? Name again? Sabaya. Yeah, so you look at I give you what are the 3 financial statements? The balance sheet, income statement and cash flow. So I give you, and what do you take out of that? Sabah. Yeah, so you take the balance. Okay, that's good. So you look at the balance sheet. Okay, so I am looking at the balance sheet. What do I take out from the balance sheet? Okay, so that's good. So let me make a real simple balance sheet for you. So this is the balance sheet of the company we are looking at. The assets are equal to 100. My, let's say, short-term liabilities, accounts payable equals 5. Then I have, let's say, simplistically, all debt is equal to 45. And what will equity be equal to? 50. Okay, so my balance sheet balances, which it should. Okay, so these are your accounting numbers. Okay, so based on these numbers, what are my weightages? And let's say there is no preferred shares. Just think. What's that? So what would I? So given these numbers, what do I put for WD? Zarak. I've asked Zarak. Okay, so very good. So here I put 0.45. What do I put for preferred shares? 0. And what do I put for? 0.5. So this is using accounting numbers. Balance sheet is based on accounting numbers. Okay, so this is what we say using accounting numbers. But 1 second, let me. So accounting, the question is, if these are the accounting numbers, but when I look at the market, let's say the market value of my bond is 45 million and the market value of my equity. What do I mean by market value of equity? Yeah, so let's say that I have 100 million shares and each share is trading for $2. What's my market value? So in the market, my value is 200 million. Is this possible that my market value is about 4 times my equity? Yeah, it's possible. So the question now is, in my weightage, should I base my weightage on market value numbers or book value numbers? Okay, how many people think it's book value? Raise your hands. How many people think it is market value? And how many people are not thinking? Okay, so the two numbers did not add up. All right, so the answer actually take a step back. Which you've all taken accounting courses? Okay, so you all understand, I hope, one core point from accounting numbers is that in accounting numbers there are lots of rules you need to follow. The rules might or might not reflect reality. For example, if you buy a building for 100,000 10 years ago, today the building is, let's say the building is on II Chandigarh Road. Today the building is worth 100 times more. On your books, will the number be shown based on historical cost or current cost? So then how useful is the number you are looking at, your accounting number? It's pretty useless, right? Okay, now let me ask but that same company, let's say that we are valuing Habib Bank. Habib, I don't know this for a fact, but I'm imagining that Habib Bank's building on II Chandigarh Road, in the books, it will be valued at some ridiculously low historical cost. But if you look at the market value, do you think the market value will reflect reality? Actually, it will do a much better job of reflecting reality. People who are buying and selling shares in that company, try to understand what the real fair value, what the real underlying prices are. So here is another core point in finance, that generally market values of equity and market value of bond do a much better job of depicting reality versus accounting numbers. Because with market values, there you can do all your research and figure out what's the fair price I will pay for the share. If the fair price for a share is low, what will happen? In general, if you go to the market and the share price, if people think that the share price is very low for a given company, what will happen? They'll buy. When lots of people buy, what will happen to the share price? It will go up. So in the market, it's not perfect, but still, if something is underpriced, everybody will buy and the price will go up. So the chances that market price is depicting reality is much higher than the chance that accounting numbers depict reality. Because in accounting numbers, you have to follow IFRS, you have to follow rules. So since you are following rules, those rules might or might not depict reality, as with the example I just gave with the building. Okay, so let me make the bottom line, then I'll take a question. The bottom line is that when you use the weightages in the WACC formula, you should use market values. Yeah. Okay. So what you do is, nevertheless, so that's a valid point, market prices are volatile. So you might take, for a given time period, take an average, but market values will give you a much more realistic picture relative to accounting numbers. Okay, if you don't have access to any market value numbers, then you can use accounting numbers. So now I'll take questions at the end, because you are going to have a quiz regardless, so we might as well finish the chapter, otherwise you'll have to do the chapter on your own. Okay, so
shouldn't the weightage is equal to 1?
the weightage should be equal to 1. So actually what here simplistically what I would do is I would round this up to 0.5 because the total debt, but you're right, the weightage should equal 1. Yeah, actually that's the smarter. So let me just make a quick correction over here. So what we should really do for weightages in this example, ideally we should take the total debt plus equity is how much? 95. It is 45 plus 50. So for this we should take 45 over 90, and for this we should take 50 over, I'm sorry, 45 over 95, and here we should take 50 over 95. That would be good, very good point. Okay, so the weights, now listen to this. The weights are the percentage of the firm that will be financed by each component. If possible, always use the target weights for the percentage of the firm that will be financed with various types of capital. I'll say all this and then make sure you understand it. If you don't know the targets, okay, first of all, what does this target mean? What this means is, let's say that you've looked at the capital structure of a company. Capital structure means the relative component of debt versus equity. Let's say a company currently has equity being 50% and debt being 50%. But you figure out that this company is going to change this capital structure. The company is targeting going to equity equal to 60% and debt equal to 40%. This is called the target capital structure. The target capital structure is the capital structure to which the company is headed, or the capital structure which the company is targeting. So the point here is that which one should we use, the current capital structure or the target capital structure? The target. The target capital structure is sometimes also called the optimal capital structure, and we'll study this later in the course. Right now just memorize the fact that capital structure that you use is based on the company target, not actual. If you don't know the target, okay, so you are the CFO, you're not clear yet what our target capital structure is, then what should you do? Use the current. Okay, so somebody said use market. There are two separate points here. One point is, do you use market values or book values? And the answer is market values. Another question is, do you use the target capital structure or the current capital structure? The answer is you use the target. So there are two separate questions, not to be confused. Obviously I can bundle the two questions up and give it to you as one question. You need to be smart enough to decipher and come up with your answer. Okay, suppose the stock price is 50. There are 50 million shares. This I want you to do for homework. Okay, it's fairly straightforward. All you are doing is the weightage. This is just telling you for some large companies in the US, what is the weighted average cost of capital. Okay. What factors influence a composite WACC? Okay, some factors are not controllable. You can just take this as a given. Does the interest rate influence WACC? Yeah, so obviously the rate on bonds is influenced by interest rates. Equity, cost of equity influenced by interest rates? Yeah, when you use your dividend discount model, or let's take a simpler one. Let's say you use CAPM. Do interest rates influence CAPM? They do, because the risk-free rate comes from here. And tax rates, how do they influence? Yeah, you have 1 minus T. Okay, and then there are some controllable factors. Capital structure policy. What this is a fancy way of saying what? The weightage that you use. How much debt? So this influences the weights. The dividend policy. How much dividend you pay, that might, this is a tricky one, but they can. So anyway, this is a tricky one. I won't get too hung up with this. And your investment policy in terms of how much you reinvest. So I think for you at this stage, the biggest one is the capital structure. Okay. Now, here is another critical. So, the composite WACC is just your overall WACC. Let's say the overall WACC for Engro is 16%. Why do you think I came up with this number? 14%. Yeah, so I say about 14.5 is bonds. I don't know their exact cost of equity, but I'm assuming that's like 19%. So I'm just coming up with a somewhat sensible number of 16%. So let's say, so now conceptually tying back to what we studied at the beginning of this course, what is the relevance of WACC? Why is knowing the weighted average cost of capital, or in short, the cost of capital, why does that help me? What? Yeah, I just wanted to wake you up. Why is knowing WACC helpful? Yeah, knowing that the WACC is 16, how do you use this? So what have we been doing for the last few hours? Next. Now, from a company perspective, why is it useful to know that? How does this help you in future decision making? Yeah, you're on the right track. I'm just looking for one.
Your return should be greater than.
Exactly. So when you are investing in a new project, would you invest in a project that gives you 15%? No. 15% looks good, but you can't just look at 15% in isolation. You say, okay, my return is 15% relative to the 16% actually. Okay, that's a great question. You cannot be sure about return, so you look at expected return, and then obviously a company like Engro is going to do a lot of analysis and probably have some buffer over 16. They won't say, okay, 16.1% return, expected return. So they will look at the risk profile. They will look at effectively maybe things like Sharpe ratio and so on. So how much, if the return is, expected return is much higher than 16% and the riskiness of the project is low, then they might go for it. But let me just continue with this. We have a couple more minutes. Okay, so what do we mean by composite WACC? That's the overall WACC for the company. But different projects have different level of risks. So let's say that you have a few different projects. Let's say you have a project L, and this project A, and this project H. Okay, you have H over here and project A and B. Okay, let's just call this M for now in the middle. Is it reasonable to say that different projects have different levels of risk?
Yes.
Okay. So is it then fair to say that for a high risk project, you would only do that project if you have a higher return? So what you effectively do is draw a line that to some extent looks like the SML line. Do you remember the SML line?
Yes.
You had the risk on the x-axis and the required return on the y-axis. So your composite M, cost of capital, you can think of as your cost of capital for an average risk project. Then for a high risk project, your required return is going to be higher. So I am not going to give you questions that are too detailed on this, but you need to understand the concept. So if I tell you that on a medium risk project, the required return is 10%, then I tell you project A is, let's say, a medium risk project, and the expected return on A is 11%. Would you do it?
Yes.
Yeah. Project B, let's say expected return is 9%. Would you do it? No. On the other hand, if you have a high risk project, let's say that your required return at this level of risk is 12%. Would you do a project that is high risk but giving you a return of 11? No. So what this is saying is that you should also look at the risk of a project. What if you are doing a low risk project with an expected return of 9%? Then you should go for it. Okay. That is it for now. So I want you to, so you can stay back. I want you to actually still, you need to prepare for the quiz on Thursday. So I'll cover, I can ask anything based on what we've covered up till now on this chapter.